Welcome back, everybody, to Volatility Trading Strategies. So since I launched VTS back in January 2012, I've always put risk management and drawdown reduction at the forefront of my investing. I've always believed that by far the best way to achieve a great long-term rate of return is to not suffer all those setbacks along the way. Because the truth is, most investors have great periods of performance when everything's working out well for them. Having a few good months, or even a few good years, really isn't that difficult. But the problem comes because every now and then the market does bite back and they suffer significant setbacks. And those can take a long time and a lot of very successful trading afterwards just to get back to that break-even point. This 2 steps forward and 1 giant step back cycle can be really costly in the long run. So this is what I call the VTS Total Portfolio Solution. It's just all of our tactical strategies combined into a diversified portfolio. It's structured, systematic, and has kept drawdowns to an absolute minimum for the 9 years since it's been live. But that wasn't always the case with me. There was a time when I was a lot more random and reckless with my trading, and that's what I want to talk about today. I'm going to show you my actual broker statement from my worst performing month ever and use it as a backdrop to show you what it taught me about investing. Sometimes seeing other people's mistakes might mean that you don't have to make the same ones yourself. So give the video a like for me if you don't mind. It really does help out the channel. And let's take a trip down memory lane and revisit a true disaster from my past. So like I said, my total portfolio solution has kept drawdowns very low in the 9 years it's been trading. This is the return distribution of all 106 months since inception in January 2012. We have an annualized return of about 20% and a maximum drawdown of just minus 7.7%. And worth noting, that minus 7.7% drawdown was fully recovered the very next month. So it only lasted a few weeks before the portfolio hit a new all-time high again. But you can see, winning months significantly outnumber losing months. And the size of the wins is a lot larger than the size of the losses. This is how I've kept my portfolio moving forward every year since I started. More wins that are larger and fewer losses that are smaller. But here's where it gets interesting because that wasn't always the case with me. Managing risk as well as I do now was something I had to learn the hard way. And this disaster I'm going to show you was instrumental in me helping take those steps towards better risk management. And hopefully it can help you as well. Okay, so this is one of my Thinkorswim trading accounts. I've had it for a long time. Now, just a side note, I haven't used this account for my long-term portfolio in many years now. I switched over to Interactive Brokers actually only a couple months after this disaster I'm about to show you. Now, that had nothing to do with the trading loss. I just switched because fees were lower and Interactive Brokers is more efficient for long-term portfolios. But I still do have this account as a test account. I've refunded it with a little bit of capital, so when I start live streams, we can take some trades together and mess around with some ideas in real time. But 11 years ago, this was my primary account. All right, so I can go over here to my statements. And for this trip down memory lane, we are going back to 2010. This is 2 years before I launched Volatility Trading Strategies in January 2012. I started trading in 2005 after retiring from pro golf, so I did have 7 years of experience under my belt before launching my business. But okay, are you ready to see some ugliness? March 2010. I remember it like it was yesterday. I'm just going to expand this so you can see it okay. So let me just scroll down here. There we go. There it is in all its glory. So you can see this is from March 1st, 2010 to March 31st, 2010. Now, don't try to knock on this door and invite me out for a beer or anything. I haven't lived at this address in years. But let's just cut right to the chase here. The line that we are looking at is this one right here. Net liquidation value. Now, some of these numbers here are a little bit hard to make sense of because there's stock, short options, and stock replacement with options. So it's easiest to look at the raw net liquidation value of the account. What it would be if I just sold everything and it was 100% cash. So prior period, that's the beginning of March, basically the end of February, I had $412,000. And at the end of March, current value, it was down to $341,000. Now, a loss of $71,000 in a single month might sound like a lot of money to some of you, and the comment section might get lit up. Or who knows, maybe it's not much at all if you're trading on a very large account size. We're not going to focus on the dollar amount. That is totally irrelevant. Of course, with trading, everybody is on a different account size, so all that matters is the relative values, the percentages. I've had gains larger than this as well, but all that matters is percentages of capital. And for the month of March 2010, you can see I took a loss of 17.3%, which was my biggest monthly drawdown ever in my portfolio. Remember, the VTS Total Portfolio Solution that I showed you, for 9 years since it launched in January 2012, hasn't had a monthly loss larger than minus 6.43%, about 1/3 of this one. And we've seen some scary crashes in the last 9 years. Thankfully, I've not experienced anything even close to this bad since then. If we go back to the return distribution of my portfolio, and I add in a minus 17.3% monthly loss, this chart starts to look pretty skewed. And if it happened, it could take a while to recover from. That's the experience most investors have. They take massive outsized losses when things don't go well for them, which makes all the easy months of gains a lot less impactful long term. One brutal month can wipe out many months or even years of gains. So a single monthly loss of 17.3%, that was huge for me and it's burned into my memory. So first, I want to talk about what went wrong, and then I'll get into what I did to fix the problem, which made me a much better investor today than I was 11 years ago. So the basic thing that went wrong was back then, everything I was doing was discretionary. And this is how a lot of traders trade. They look out into the market, they find opportunities they like, and then they just allocate capital based on the strength of that trade at the time. So some months for me, I would be long, and then other months I'd be short. Some months I'd be very heavy in short options, and other times I'm buying long options. Sometimes I'm fully allocated with my capital. Other times I have a lot of cash on hand. It was always different because I was discretionary. And of course, there's nothing wrong with being discretionary when everything's working out. Even new traders, brand new to the game, they have periods of success when everything works out. But the flip side of that is, everybody, including even the most successful investors, we all have periods where we just get it completely wrong. That's how I ended up with a monthly loss of 17.3%. Obviously, what I thought was going to happen with my trades didn't. And when discretionary trading goes wrong, it can really go off the rails. You find yourself down a little bit, so you do something you think will stop the bleeding, and then that doesn't work. Then you think, well, surely it's going to reverse now, and then it doesn't. With discretionary trading, things can go from bad to worse pretty quickly. So what did I do to fix the problem? Well, essentially, I shifted my investing philosophy from being entirely discretionary to being almost entirely systematic. I would divide up my capital into much smaller portions, and I would only allocate those portions of capital to many individual independent trading strategies. So I can show you my portfolio allocations that I'm taking into 2021 as an example of this. Now, 11 years ago, it wasn't quite this organized, but I did start on the systematic path immediately after that loss in March 2010. And within a month, I had divided up my capital into much smaller portions dedicated exclusively to individual strategies. And I'm definitely thankful that I did because it served me very well just a few months later with what happened in the flash crash in 2010. I'll do a follow-up video for that soon. But you can see what this is. My capital is currently divided up into 11 different sections, and I only trade that strategy with the capital that's available. So it doesn't matter if I think something different in the moment, if I'm emotional, or if I want to chase what I feel is an opportunity. If I want to do that, I'll have to cut off a small portion and go down that road with just that amount of capital. So importantly, I remain systematic, and all of these are traded independently of one another. So as a quick example, if I highlight one of them, the VB threshold strategy, for example, this is a strategy that allocates to trades based on current volatility levels in the market. So I rank overall market volatility from low to high, and each 20% section we will be holding a different ETF that best matches that level of volatility. And you'll notice this individual strategy can be holding aggressive positions like short volatility SVXY, as well as the S&P 500, but it also has safety positions of bonds and aggressive market short positions of long volatility with the VXX, strategically when it makes the most sense. So on its own, this is a tactical strategy that has both aggressive and safety positions to make sure that in the long run it reduces drawdowns and outperforms the market. And the same thing applies for all the other ones as well. They are all tactical. They all have both aggressive and safety positions available, and each one of these strategies on its own also outperforms the market in the long run. So when I combine them all together, it achieves two goals at once. First, since they all outperform on their own, putting them all together in a broad portfolio means the same is true. But secondly, it also means that I'm much more diversified and much better protected against drawdowns. Each of the individual strategies can, of course, suffer drawdowns sometimes. That's normal for all strategies. Nothing works in all environments. But when you combine them together, there's always a few of them that are working, even if a few of them at the time aren't. Which means long-term, my drawdowns have been reduced to very low levels. Now, to help people follow along, I have divided them up further into a more conservative and a more aggressive portfolio. And VTS community members can choose the one that best matches their risk tolerance. Or they can do both like I do. I learned a long time ago, as I showed sometimes quite painfully, that having multiple independent strategies working together is by far the best way to manage drawdowns and crush the market long term. So there you go, March 2010, definitely not one of my finer moments, but sometimes some of the best lessons we learn come from the biggest mistakes that we make. I wish it wasn't this way, and like I said, hopefully seeing somebody else go through the problems, maybe it'll save a few of you from having to make the same mistakes yourself. I know personally, I'm way better off for having gone through this experience, and my performance in the past 11 years has been very good because of it. Sort of an aha light bulb moment, if you will. So hopefully you enjoyed this painful trip down memory lane with me, and if you do want to see how my portfolio performs, how all those strategies work together, there is always a free trial on the website. You can check it out for a couple of weeks, see if the VTS community is right for you. You're more than welcome to join us. See you next time. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.